two trainees sat with me who just had a question. Well, I'll let him ask the question again, or just give me the general tone of what the question is, and then we'll address it, because it's about the UK data we've just had.
Basically just asking how to trade the pound when it's already positioned before the data's come out, and the data beats the expectation, but not massively. So it's how to trade it on a small beat, basically.
Yeah. So the one interesting thing is with UK data is you do get a degree of pre-positioning. Now, one of the main things here is that this isn't a leak. Someone has not paid for the privilege. It's not a hedge fund who's got access to it ahead of time. What often happens is that because you see this pre-positioning UK data very close to the release, is that people then start to see that movement, and obviously it's going to spark talk or chatter, rumour, that it's a strong number. And then if you have that belief, and it becomes almost self-fulfilling. The price started rallying at 11 past, it then started creeping higher, and then we had another quite powerful move about 3 or 4 minutes ahead of the actual number comes out. So a lot of the people here will be following the trend and the momentum, and actually coming out of the position, and the trade that they've executed is actually before the figure even comes out. So they're just following the fact that people will be buying into the idea that it's going to be a strong number, so they already bid into the figure. I take that long, and then I've booked the profit. I'm out for 20 ticks. And obviously you won't want to be keeping a position over a data release, because obviously you can get caught out on a big spike, and obviously you don't know what the number's going to be. Now, in this case, the number came in, so UK GDP Q3 Advanced reading, first look at Q3 growth, 0.5%. Now, in the run-up to this, we were talking about the fact that the market was probably positioned for that because the underlying economic data post-Brexit has been, on balance, more good than it has bad. So that would make sense, right? You should have a good number. And so you get the initial, let's say, spike, which is what I would call the fast money move or a high frequency move, which is the execution, the fact that in terms of a median consensus, we've come out on the right side of that, the upper side. The only problem is that it's not a super outlying number. It's not a 0.9%, let's say. If it was 0.9, then certainly we would have gone through R1 on the upside, you can see there. But what's happened here is you get the fast money knee-jerk higher, and then from the point of the high of the data, all the way from where we rallied, actually when we were pre-positioning at 20 minutes before the figure, that's actually a move from 22.30 up to 22.84. So you've already moved a pretty much a half a point. So for me at that point, you probably heard me on the mic, I was saying I wouldn't feel comfortable on that better data taking along. Because for me, the market's already built in half a point which reflects the beat. And so for me, actually, the trade is a short rather than a long off the high. Because my thinking being that ultimately everyone is of the view that the UK economy is going to deteriorate, economic data is going to worsen, and this is somewhat backward looking in a way. So the market's already gone up, it goes up again because you have a slight beat, but that almost offers a better opportunity for a pullback.
Just almost like the bigger picture then.
I'm almost, it's trading two things. It's trading first and foremost, I'm looking very objectively short term on how the market's positioned. And for me, this market is overly priced the value of sterling on the information at hand for this specific event. 0.5 is not good enough to warrant a sustained move beyond the 50 pips that have been built in over the last 20 minutes before. Then combination with the longer term view that I think that even at 0.5, what does it matter? Everyone knows the pound is on the downward trend and things are going to deteriorate as prices rise and data weakens. So, and hence you get a bit of a pullback.
Now we're back to square one.
I would say a final kind of lesson as well, talking to some of the live guys. Obviously, when the number comes out, you hear the squawk call the number. Everyone has a sigh of whoa and like wonder. You know, as an intraday prop trader, you know, you can't trade the spike. You know, the high frequency move, the fast money move. There's no point even entertaining the spike. Now, the benefit that you have, though, as a human, is your interpretation. So this longer term view, this assessment of the pre-positioning and where I feel fair value is of the asset, that's all me with my own analysis, interpretation of how I've seen previous price movement, what I see in the longer term macro-wise. And if this is just for GDP, but if you think about Draghi or a Fed statement, very difficult for a machine to trade that, because you're trading sentiment, you're trading intonation in someone's voice, all these sorts of things, which are very non-binary, if you like. Okay.
Yeah. Cheers.
Hope that helps.
Yeah, it does.
No worries.
Thank you very much.